How many times have you taken a trade, only to get stopped out right before the market moves exactly where you predicted? Frustrating, right? That's where order blocks come in. In this video, I'll show you how to combine order blocks with market structure to find high probability trade setups, the same way banks and institutions trade. If that sounds valuable, make sure to hit like, subscribe, and turn on notifications so you don't miss future videos. Let's get started. So, what exactly is an order block? In simple terms, order blocks are refined versions of supply and demand zones. From basic price action theory, we know that markets move in impulsive waves, followed by corrective pullbacks, all driven by the decisions of market participants. When an impulsive move begins to the upside, we mark that starting point as a demand zone. Why? Because that's where buyers previously stepped in with strong conviction. If price revisits that area, there's a high probability buyers will look to re-enter and push price higher again. On the flip side, when an impulsive move begins to the downside, we call that starting point a supply zone. This is where sellers previously entered the market in size. If price comes back to this zone, chances are sellers will step in again and defend it. Now, here's where order blocks take things a step further. Order blocks are a special type of supply and demand zone, but instead of being defined just by retail buying and selling pressure, they're created when large institutional orders hit the market. These orders cause a sharp imbalance between buyers and sellers. We often see this imbalance through what's called a fair value gap. That's when price moves so quickly in one direction that it leaves unfilled orders behind, essentially creating a vacuum in the chart. The market often comes back later to fill that gap and rebalance. In practice, we mark the last candle before the gap as our order block zone. That's the candle where institutions likely made their decisions. If price returns to that level, it often reacts sharply because those large players are still active around that area. So, to put it simply, order blocks are supply and demand zones with a twist. The key difference is that they highlight areas where the big money, the banks and institutions, are placing orders. That's what gives them so much power in trading. Now let's talk about how to actually mark your order blocks on the chart. The rule is simple. We take the entire candle before the fair value gap and mark that as our order block zone. The color of the candle doesn't matter. Green, red, or even a doji with barely any body. All of these can form valid demand order blocks in the right context. Here's an important detail. Sometimes you'll see a wick grab liquidity just before the imbalance occurs. In that case, make sure to include the wick as part of the order block zone. That wick often represents the real starting point of institutional activity. And when that happens, your stop loss should always be placed below the wick for protection. Now, not all order blocks are the same size. If the order block is small, you'll want to use a slightly wider stop loss beneath it. Why? Because even though order blocks are strong zones, price doesn't always react with pinpoint precision. Giving the trade some breathing room avoids unnecessary stop outs. If the order block is large, one smart approach is to look for entries around the middle of the zone. That way, you're getting a better average entry price while still respecting the overall zone. The key idea is that order blocks act like magnets for price, but your entries and stop losses need to be adapted depending on the size and shape of the zone. So, what makes an order block high quality and worth trading? The answer can be found in its alignment with market structure. In a strong uptrend, price moves by forming a series of higher highs and higher lows. Every time price breaks structure to the upside, it confirms that buyers are still in control and the trend is intact. Along this path, the bullish order blocks that form act as reliable reference points. When price pulls back into them, they often serve as launch pads for the next move higher. This continues until the market breaks below a protected low, a critical point that buyers were previously defending. When that level gives way, we call it a change of character. This shift signals that sellers have stepped in with enough strength to reverse the trend. At this moment, the bearish order block responsible for breaking structure becomes a prime area to look for short opportunities. Of course, market structure has many more layers like liquidity sweeps, mitigation blocks, and continuation patterns, but this gives you a clear, practical framework for understanding how order blocks connect to structure and how to use them in real trading. This strategy works best when you use two timeframes, and we've simplified it into a clear set of steps. Identify the order block. Spot the candle before the imbalance that created a strong move. Mark the order block. Draw the entire zone on your chart so it's easy to track. Wait for a pullback, be patient, and let price return to the zone instead of chasing the move. Look for a candlestick signal. Inside the order block, wait for a clear reversal pattern like an engulfing candle or a strong rejection wick. Check your risk to reward ratio. Only take the trade if it offers at least a 2-to-1 reward to risk setup. Confirm with the higher time frame. Switch to the higher time frame and analyze the overall market structure. If it aligns with your trading time frame, you've got strong confirmation. Execute the trade with discipline. Place your entry, set your stop loss, and manage the trade according to your plan. By following these steps, you make sure every trade is backed by structure, confirmation, and risk management, not emotion. Now let's walk through an example so you can see exactly how this strategy works in practice. Here, the market is clearly trending upward, and we spot a well-defined bullish order block. Why? Because this is the last candle that formed before a strong imbalance, the fair value gap that pushed price higher. So we mark that candle as our order block zone. Next, we wait for a pullback. Notice how price comes right back into the zone and then rejects it with a pin bar candlestick. That's our confirmation signal that buyers are defending this order block and the market is likely to continue upward. Since this setup is forming on the hourly chart, we need to confirm the bigger picture. For the 1 hour time frame, the higher time frame we use is the daily chart. So we switch to the daily, and what do we see? The structure is bullish, making higher highs and higher lows, perfectly aligned with our trade idea on the hourly chart. With that confirmation, we go back to the hourly chart and set up the trade. Entry at the close of the pin bar signal. Stop loss just below the wick of the order block. Target set for a minimum of 2-to-1 reward to risk. And from here, it's simple. Set the trade and let the market do its thing. In this case, price reacts beautifully, respects the order block, and hits our target, giving us a solid reward to risk ratio. Now, it's important to remember, no strategy is a holy grail. You'll have losing setups too. But later in this video, I'll show you exactly what to do when the market goes against you, so stay tuned. Now let's talk about time frame analysis, because this is a key part of the strategy. In this system, you'll always work with 2 time frames. Your lower time frame, which is your trading time frame, your higher time frame, which gives you the bigger picture of the market. Here's how it breaks down. If you trade the daily chart, your higher time frame is the monthly. If you trade the 4-hour chart, your higher time frame is the weekly. If you trade the 1-hour chart, your higher time frame is the daily. If you trade the 5-minute or 15-minute chart, your higher time frame is the 1 hour. And if you trade the 1-minute chart, your higher time frame is the 15-minute. Here's how you use this in practice. On your lower time frame, you look for the actual trading setup. This means identifying the order block, checking that it's a high-quality zone, and waiting for your confirmation signal. On your higher time frame, you analyze the overall market structure. Is the market trending up, trending down, or consolidating? If the high time frame direction is aligned with your setup on the lower time frame, that's when you have a valid trade. You take the entry on your trading time frame, but your confidence comes from knowing the higher time frame agrees with your idea. Alright, now let me walk you through a trade example so you can see exactly how this strategy works in real market conditions. Here we're looking at the Euro-US dollar 1-hour chart. First, notice how the market is trending upward, creating higher highs and higher lows. This tells us buyers are in control. Then we spot a bullish order block. It's the last bearish candle before a strong bullish move created an imbalance. So we mark this candle as our order block zone. Next, price pulls back into this order block. Inside the zone, we get a bullish pin bar candlestick, which acts as our confirmation signal that buyers are stepping back in. Now, before entering, we check the higher time frame. Since we're on the 1-hour chart, our higher time frame is the daily chart. On the daily, we can clearly see the market is also trending upward, perfectly aligned with our 1-hour setup. With that confirmation, we go back to the 1-hour chart and set up the trade. Entry inside the order block zone to achieve a favorable reward to risk ratio. Stop loss just below the wick of the order block. Target set for a 2-to-1 reward to risk ratio. From here, it's just a matter of letting the trade play out. Price respects the order block, pushes higher, and eventually hits our target, giving us a clean 2-to-1 trade. This is a textbook example of how powerful order blocks can be when combined with market structure and multi-time frame analysis. Now, let's flip things around and look at a bearish scenario. This is the US dollar, Canadian dollar on the hourly chart. As you can see, the market is trending lower, forming a series of lower lows and lower highs. Here, we've identified a clear order block. Now, let me ask you a question. Why do we call this an order block and not just a supply zone? The answer is simple. An order block creates an imbalance in price. In this case, you can clearly see a fair value gap left behind. When this happens, the market is very likely to retrace, fill in that imbalance, and then reject the order block. That rejection is where we look for our entry. So after spotting the order block, we don't jump in right away. We wait for the pullback. Look at what happens next. Price pulls back, taps into the order block, and then rejects it strongly. This gives us a clean entry opportunity to short the market. But before pulling the trigger, we need to confirm whether this setup aligns with the higher timeframe bias. Let's move up to the daily chart. On the daily timeframe, the market is ranging. Notice how it was recently rejected from a resistance level, creating what we call a liquidity sweep. Price ran stops above resistance, then quickly reversed back down. That's a strong signal that the daily timeframe is likely to push lower toward the support level. This higher timeframe context supports our short setup on the hourly. Now let's switch back to the hourly chart to see exactly how we take this trade. On the hourly, our entry is placed at the close of the rejection candle inside the order block. The stop loss goes just above the order block zone, protecting us from false breakouts. The target is set at the next support level. And look what happens. Price moves exactly as anticipated, running straight to our target. This trade worked out perfectly because we combined order block confirmation with multi-timeframe analysis and liquidity concepts. Now let's talk about something really important, the set and forget method. Here's how it works. Whenever I spot a high probability trading setup, I do all my analysis first. Then I place my entry, stop loss, and target. Once that's done, I simply set the trade and forget it. Why is this so powerful? Because if you don't, the market will play games with your emotions. Think about it. You enter a trade with a mental stop loss and target, and you keep staring at the screen. Price starts moving toward your stop loss, your nerves kick in, and you panic. Chances are you'll close the trade too early, and then what happens? The market turns around and hits the exact target you were aiming for. Frustrating, right? That's why discipline matters. When you set your trade with clear risk and reward in place, you already know two things: how much you'll lose if the trade doesn't work, how much you'll win if it does. From that point on, there's nothing left to worry about. Let me give you a quick example. Suppose you're trading on the hourly chart and you've identified a high-quality order block. Everything checks out: the structure, the alignment, the confirmation. So you set your entry, your stop loss, and your target. Now here's the reality. Price might take hours to play out. Every candle represents 1 hour, so you could be sitting there for 8-10 hours watching the market move up and down. At some point, price might even come close to your stop loss before shooting higher to your target. If you were glued to the screen the whole time, you'd probably close early out of fear and miss the winning trade. Instead of wasting hours staring at the chart and getting emotionally drained, the smarter choice is to set the trade, walk away, and let the market do the work. That's the real power of the set and forget method. It saves your time, protects your mindset, and keeps you consistent. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you don't miss future content. And if you have any questions or want me to cover more topics, let me know in the comments. Thanks for watching, and I'll see you in the next video.